Okay, buddy, and welcome back. And let's go in and get this news out of the way, and we'll take a look at the charts. And as I said, I was telling the guys, I go, I just don't, right now, I think people are kind of easing back. They're going to wait for the U.S. session. So if you want to try and grab a dollar here, grab a dollar there in some of these markets, you can. But I think we're just kind of pushing back and forth on these markets, although I think there's obviously an underlying bid tone. Um, to the ZBs, to the euro, to the gold, and I think you have to be cognizant of that. I mean, gun to my head, I'd rather be long the euro, long gold, long ZB than the other way going into the U.S. session. That is, and we talked about that yesterday. We saw the same thing yesterday. Remember, our concern was we were talking about the ZB selling off in the morning, and as they got down to what was it? I think it was 50.06 yesterday. And I said, hey, look, you're going to see these ZBs go on to the bid as we get closer to the U.S. equity open. And sure enough, we saw them go from 50.06 by an hour later. I think it was they were already at 50.21. But anyway, it says, let's get on to this story. It says, the yen rises versus the dollar despite widening U.S.-Japan rate differential. The Japanese yen's recent rise against the dollar has defied conventional market wisdom, but a strong currency may actually support Japan as it confronts the Trump administration on matters of trade and foreign exchange. The Federal Reserve's explicit plan to raise interest rates this year, in contrast to the Bank of Japan's persistently accommodative monetary policy, should in theory be a reason for investors to move out of the yen and seek the yield in the greenback, the so-called carry trade. However, growing investor doubts about President Trump's economic stimulus plan have hurt the dollar in recent weeks. Meanwhile, Japanese Prime Minister Shinzo Abe, now in a rare fifth year as leader, is battling scandals on two separate issues, driving funds into the safe haven yen. We've already talked about that, and why we've already said, and we were talking about earlier this morning, how we continue to remain near these lows in the yen. I pointed out yesterday. I mean, for those who are just coming on right now, we can go back and forth on this news, but I think the news is kind of, like I said, set the tone. And I'll spend a little bit more time talking about that. But you can see here that yesterday, we're looking at the dollar yen here. Hang on. Yesterday we talked about this area. There's that zone. I had it even penciled in here. Look right there, 1079 to 1094, and the lower part of the zone they got just a hair below it, and they defended it right here. Basically got a tweezer bottom. There was just a hair lower. And look at this, a very nice rally. But look how we quickly rolled right back down. So people are, once again, they're keeping the bid in the yen, the story is saying, is a safe haven play. So you're seeing this across the board. And I'm going to dance all around here so we can tie this all together so everybody's on the same page. So you can see how the yen continues to remain well on the bid. You get a bounce, and they quickly sell into this bounce as they buy the yen for the safe haven trade. Here's another one right here. We're going to jump in here as we go back and forth in the news and into the technicals. Look here at the gold market. We got all the way up to 78% and got just above it, and we get turned away. Well, you would think, well, heck, after a run like this, they're probably going to come off pretty big, because look, that's a pretty doggone good run. And look at this. It's still staying on the bid. But why? Because everybody is looking at what's going to happen with the equities. And like I said, we don't spend a lot of time sitting here at all talking about SPOOs. But like I told people yesterday, when I was talking to them in the afternoon, I said, hey, look, I think the equities are going to be okay today. And I wouldn't say it with a ton of confidence, but I said, I think they're going to be okay. I go, but what you want to look at is tomorrow afternoon, which is today. This afternoon, because I think that we can see that pressure come back on to the equities, which, once again, I told you we're going to be dancing all over the place so that everybody's on the same page. Okay, so there was my level here. We already discussed it earlier, that 23.35, 23.38, being the 38%. But holy smokes, this rally was about as feeble as all get out. Look at that. I mean, we were just at 23.90, and look, it wasn't that long ago, about 3 weeks back, we were here at 2,400, but last week we were 23.90. We sell off almost 60 handles, and all we can put together is a 15-handle rally. I mean, that's basically a 23% here, or just a hair above it. Like I said, we had already sold off here. Okay, good. We rally back up. Okay, fine. It didn't rally all the way. They're going to use the opportunity to sell. So they took out these lows here across the board. This low, this low, this low. Coming here, you're thinking, okay, we should get a good bounce because we probably knocked a lot of people out of the box. And look at this rally back, as feeble as all get out. So this is one of those times where even though you're trading the technicals, you have to look at what's the overarching theme. Obviously, right now everybody's talking about this healthcare thing. I don't think it's as big of a deal, but I think that symbolically, and I wouldn't say because symbolically might mean a too strong a word, but I'm saying is it basically stresses that it's like a more key piece of further holes being knocked into the Trumpflation trade. I mean, I don't think that there's anything necessarily wrong with it, but what they're starting to say is at these high levels, and let's go back here into the S&Ps. I got to find my mouse. What the heck is a mouse? Too many screens on here. It's not like, oh, that trade's no not good anymore. Who believes that junk or whatever? It's not that. It's just at this level, the rally that we've had. Forget the November election low. I'm talking about just from here. So the rally, people saying, wait a minute, you got to start to show me some results. You got to start to show me that there's something behind this trade, and they're not seeing it. So people are saying, those that got long on the Trumpflation trade, not here, not here, not here, but they got long, let's say, at 22.75. They're going, hey, look, I've already given up half of my gains, but I do have gains and decent little gains from 22.75. I'm just using an example here from 22.75. You know what? It's probably easy for me just to walk away. And I tell you what, if they come back down here to this 22.75, I'll be more than happy to buy it. But for right now, I think I'm just going to step away. And like I said, the news keeps getting more negative. And like I told you before, sometimes the market will get like that, where it's like the glass is half empty. And so people are starting to shoot holes into the efficacy of this trade. And at this point now, the market starts to lose, the momentum starts to wane. And that's what I was saying when I showed you in the gold. Look at the bond market. Look at this run that we've had in the bond market. I would have said, okay, now we're going to pull back. And we could get like what we saw here the last time here on this run to 52.24. The market rallies and runs out of gas. But we actually rallied here and we came up here pretty solid here. Here's the deal. Technicals are technicals, but I learned long ago, and in a very expensive way when I was watching the euro. This is, about 3 years ago, 4 years ago, when I saw the euro go from 122 or whatever it was on up to like 130, like the mid 130s. And I was like, yeah, and I remember talking to Mark Dow, and I'm like, oh, this is stupid. The employment is terrible in the Eurozone. This is terrible. You can't tell me that there's no way that this is stronger than the dollar. And he was like, he's pointing out that the flows, and basically you can't fight the flows. So you can say here from a technical standpoint, although technically if you looked overall you'd say, well, it's on a buy mode, but I'm saying technically, well, this thing's way overdone. I don't know what you're talking about. Or one gentleman asked me, as I mentioned earlier in the show, in the agency, he said, so you're he didn't say it sarcastically, he was just saying, okay, so you're bullish now of the ZBs. I go, it's not that I'm bullish, because I'm not bullish to ZBs. Although you look at it, you have to say, yeah, this is bullish so far, but it's overextended. I told him, I go, you can't fight the flows. So here's the deal. If this market is way overstretched and we come back to after 60 handles, we can only, after they took out, we come down here, we rally back up, we take out all these lows to clean everybody out, and yet we can only get a 15 handle rally. If we take this next level down here, and I don't think the wheel's going to come off the caboose, I just think that it'll just start sliding back, and people will say, hey, I'll pick it up at 22.75. I'll pick it up with both hands. I just don't want to be in it right now. So if we start to roll over here, where do you think that money's going to go to? It's going to go into the bond market as a safe haven player, just somewhere to park their money. You can't fight the flows. That's my point. That's why, and we'll go back into the news, we have to tie the news, but I think these markets aren't moving anywhere, so it's not like we have brand new technicals to go over. That's why you're still seeing the bid remain very solid in the gold market. That's why you're seeing the bid remain solid in the yen. Despite the fall that we've come into, we've had a pretty good fall. And I shared that with y'all yesterday. We talked about this area right there. I shared it with y'all right there. The zone, 1079 to 1094. You take a look at that low. And I was talking to some guys right when we got into that low. I didn't go in the yen. I was already in the euro, and I thought I was going to get stopped out. I mean, fortunately, I didn't. But I mean, I thought I was going to get stopped out. I'm like, I'm not going to stand away in front of this train. I'm just saying, like I said, this is one of those times where I'd rather be cautious. I'd rather be cautious. And I was telling some guys earlier, that was when the euro was trading at 772 or 771, and I said, they might try and goose the stops lower. And you know what? I might miss some moves. I may be wrong, but I'll tell you what, I don't mind missing some moves and being wrong if I'm going to play it from the cautious side. And look, the euro has now rallied, and the euro should be lower after getting turned down, technically speaking. Now, overall, on a daily chart I already just showed you, there's nothing yet to show that the euro's gotten. Anyone that's looking for above 109, they're not. They're still long euro. They haven't gotten knocked out of the box. But if you see this isn't a 30-minute chart. It's a 2-hour chart. And look how these guys have been pushed away. They even took out buy stops here, and there was no follow through. Well, the move lower today, all things being equal, we should have been here around 740. It reminds me of what Pipzar says, what can't go down must go up. That's what I'm saying, is there's not, so I think it's, technically you're saying, well, this doesn't make any sense. I mean, yeah, it's still in the buy mode, but it got rejected pretty good here at this 819. They even took out the stops. You can't fight the flows. If we get a turn down, now if the SPOOs, I don't think so. But if they pass this healthcare bill, yeah, the SPOOs are going to rally up to about 23.75. They may even make it up to 23.80. But I don't think that's what's going to happen. But if the SPOOs start to roll over, not in a hardcore way, but they start to roll over in this afternoon and it carries over into tomorrow, good luck trying to stand in the way of the euro or in front of gold or in front of the ZBs, because you can't fight the flows. Let's go back to the news story. Like I said, we're starting technicals late today because you know what? We haven't had no big moves. So it's not like we have to change a lot in the technicals. And I wanted to make sure that we covered this news because it's setting the theme for what's happening. This way, nobody here on the webinar, depending on how you trade it, that's your business. But nobody can say they got caught with their pants down. Now, you can totally ignore what we're going to cover today. That's fine. But you can't say, if we get the equities to start to turn lower, whether it's today, tomorrow, or whatever, and I'm not an equity bear, I'm not an equity alarmist, but if we do get these start to pull back, and just a reasonable correction from people saying, hey, look, we've come so far, I'm just going to put my hands in my pocket and I'll wait till we fall maybe another 50 handles and I'll step in and buy it then. Well, if that allows the euro then to push even higher and the gold to push higher and the ZB potentially to push higher, you can't say that you were caught down with your pants down. And like I told you, it's the old saying, you learn the most from your losses. And I'll tell you what, I remember taking the other side of the euro at 120, 127, and the thing just keep on going higher. And marked out telling me you can't fight the flows. The flows are in the euro. I tell you what, like I said, I learned my lesson pretty good on that one. That was, like I said, about 3 years ago, 4 years ago, whatever it was. But I remember, you can't fight the flows. And equity market is a pretty big market. So if people want to get out of it, they're going to move into the ZB. And if the ZB goes higher, that's going to open the door for the gold to move higher. And it's going to open the door, if the ZB moves higher, which will be lower rates, it's going to move people, it's going to push the dollar lower. So let's go back in and finish this news. Too many doggone screens. I end up losing this mouse. Okay, so let's go back into this. While a stronger yen is typically bad news for Japanese exporters, it provides some reprieve for an economy that the United States is accused of exploiting a cheap currency for growth. The Japanese authorities are aware of these trade threats and have been proactive in trying to manage the relationship with President Trump. Economists at Oxford Economics said in a report earlier this week. And if the idea of a weak yen becomes a contention between the two countries, Japan could ignite the yen to be stronger. Baseline projection of 118 to the dollar, they said. The yen is now around 111 per dollar, and the highs last seen after Donald Trump was elected U.S. president in November hit 1073 on Wednesday, its highest since late November. Analysts expect the yen to remain strong. Dollar yen should be around 114, concerning around the U.S.-Japan current yield spreads, but it has drifted down to 111 on worries over political risk, said Yukio Ishizuki, senior currency strategist at Daiwa Securities. Ishizuki expects the dollar value will fall towards 110 yen in the next 3 months, occasionally even dropping below that threshold. The yen's rise comes conveniently just weeks before U.S. Vice President Mike Pence visited Japan and meeting with Deputy Prime Minister Taro Aso, who doubles as Japan's finance minister, to discuss bilateral economic issues. Japan's large trade surplus with the U.S. has stirred fears that the Trump administration might press for a stronger yen. Data on Wednesday showed Japan's exports to the U.S. grew the most in roughly 2 years. There appears to be concern about the feasibility of U.S. policies going forward, says Shushuki Yamada, senior strategist at Bank of America Merrill Lynch in Tokyo, referring to the dollar flagging against the yen. Wariness that Trump won't tolerate a strong dollar, for example, a rise by the currency to 120 yen, also seems limiting the scope for the dollar to gain against the yen, Yamada said. In theory, the yen should be weaker. Yen differentials between the U.S. and Japanese 2-year bonds were at 1.6 percentage points earlier this month, the widest since April 2008. The U.S. long-term differential rose about 2.5 percentage points in December, twice in 7 years. A tentative revival of interest in carry trades in which investors borrow cheap currencies such as the yen at low rates and invest in assets that offer high returns should also technically weaken the yen. As Abe faces questions on his ties to nationalist school involved in a murky land deal, and his defense minister faces calls to resign, political uncertainty has added risk. And if the dollar's woes may reverse if concerns about Trump's policies abate, investors' confidence in the dollar faces a crucial test later Thursday when Trump's own party votes on the government health care legislation, a rejection of which could delay the tax reform and infrastructure boost. And like I said, that's what's driving the market right now. And like I said, I was telling people earlier in Europe and here on the show is, whether you like it or not, the spoons are driving the bus right now. They're driving the bus across the board as to what's going to happen in the ZBs, as to what's going to happen in the gold market, because that's going to be impacted by the ZBs, as to what's going to happen with the dollar. Eurozone banks take up more ultra-cheap ECB loans than expected. Eurozone banks took up more ultra-cheap long-term cash from the ECB than expected on Thursday, tapping into the last auction of an unconventional tool designed to revive the bloc's economy. Some 474 banks have, took up 233.5 billion euros of 4-year loans, last targeted long-term financing operation called TLTRO, well above the 125 billion euros expected in the Reuters poll, suggesting that banks are keen to stock up on cheap cash in anticipation of a continued rise in lending. Unveiled a year ago when the lending growth hovered near zero, TLTRO provides banks with interest-free funding and even a possibility of a rebate if they lend cash to the real economy. But corporate lending growth is at its highest since 2009. Economic growth is relatively robust. So the ECB decided last month not to extend the TLTRO scheme, a move seen by as a small step toward policy normalization. We did show that is that we've had the strongest purchasing managers indexes in the Eurozone in 5 years. So you're seeing reasons why the euro could go on and rally further. Like I said, I think, my target after FOMC, I told you, I think we're going to get past 859. I thought we were somewhat extended here in the euro, but it's holding up relatively very well. And part of that reason is because of the downdraft we saw in the SPOOs. Swiss National Bank Central Bank bought another 67.1 billion Swiss francs. Swiss Central Bank bought another 67.1 Swiss francs of foreign currency in 2016, almost a quarter less than the previous year, in its effort to fight the appreciation of the safe haven franc. These interventions occurred mainly at times heightened uncertainty when the Swiss franc was particularly sought after as a safe haven investment. Currency interventions and negative rates are the SMB's main tools in its campaign to weaken the franc, which is consistently described as significantly overvalued. Strong franc complicates life for Switzerland's exporters by making the products more expensive outside the country. As a result, the SMB's foreign currency purchases, its balance sheet has ballooned to more than 740 billion francs, larger than the entire Swiss economy, raising concerns it could swing between big profits and losses in the future. As a result, to safeguard against such swings, the S&B more than trebled the 4.6 billion francs the fund and it's set aside as a cushion. Total provisions for the currency rose to 62.8 billion francs at the year end. The S&B is not required to make a profit with its main mandate. Oh shoot! Oh god, thank God! I almost pushed this button to clear everything out. The S&B is not required to make a profit with its main mandate to ensure price stability in Switzerland, but any portion of any profit does make it distributed to the Swiss government and the country's 26 cantons. Sterling hits a 1 month high versus dollar after surprise UK retail sales. We did see the sterling move up. We had an area there of 25, 37.40, which it didn't get to, which I thought would have been a nice little short. I know Anders was looking at that 25.40. I thought I was going to get there on this little surprise run up, and it just came up short. But other than that, I know myself, I'm not doing anything. I'm just going to sit back and wait because this is where all the action is happening, and it's going to be into this U.S. session later on. Anyway, so sterling hit a 1 month high against the dollar on Thursday. If UK retail sales data came in much higher than expected, soothing worries about weakening consumer sentiment in Britain as it prepares to leave the European Union. Sales volume in February rose to 1.4% in January, beating the 0.4% increase forecasted by Reuters poll of economists and reversing 3 consecutive monthly declines. The pound traded 24.78 ahead of the release, hit 25.22 after data, its highest since February 24th. It's also up 0.4 on the day at 86.11 pence per euro. The concerns about the UK economy are overdone, said Nick Gardside, the International Chief Investment Officer for Fixed Income at JP Morgan Asset Management. You look at the CPI release on Tuesday, you look at the retail numbers today, and it does feel like the Bank of England can begin to think about raising rates. Why shouldn't it? So when we come back, we'll just finish up on the dollar and the gold market on some news, and then we'll go straight into technicals. Like I told you, there has not been any significant change, so we'll be able to fly through these technicals. But thanks for joining us here on the Morning Edge webinar.